Hi there, welcome to another live webinar with us from Phillip Nova. This is Sri, your facilitator of the day. And what are we going to be talking about today? It's going to be the geopolitical tensions and inflation. Will gold be the ideal hedge? And with us in the studio is David Lowe. David, honestly, this whole year I've heard no talk on gold. Everything was just on the dollar. And if you've attended our webinars before, you probably know who David is, but for those who do not know, let me share David's profile. David is a full-time trader and managing partner of Xmodeus Trading Group, consultancies specializing in providing bespoke trading strategies and coaching for private and corporate clients in the equity and commodity derivative markets. He has 24 years of experience, lots of experience in the Malaysia listed derivatives industry. And before starting his own consultancy, David held leadership positions in futures broking divisions of major investment banks in Malaysia. He's the immediate past president of the Malaysian Futures Brokers Association from 2018 to 2019. And he's a fervent believer in trader education. It's very important. Keep yourself updated. And he has spoken in numerous seminars and workshops, numbering workshops up to 5,000 retail traders on trading in Bursa Malaysia derivatives as well as for CME, SGX, Hong Kong Exchange markets. This includes live market trading sessions, so he's very experienced. If you have any questions at any point in time during the webinar, please type them into your question box, which you can find on your control panel on the bottom right of your screen. And what will we be discussing today? We will be discussing gold, and David will be giving his views on key factors currently driving gold prices, and he will be providing potential price direction scenarios for the coming weeks. And David will also share some takeaways for you, trading strategies that you can utilize when trading gold. And these are more or less the key points that David will be walking us through. Hopefully we have some little bit of bonus tips from David himself. And before I hand the reins over to David, I just want to do a quick sound check. If you hear me loud and clear, please type yes in your question box. It's on your control panel somewhere at the bottom. You'll see a box titled questions. You can type your response of a yes in there, and just to let me know that you can hear me clearly. At any point in time, you may type your questions in the box, and we will pick them up, rest assured, during the Q&A segment. All right, David, if you are all set to go, we can hand the reins over to you, and you can walk us through your views on gold. Will gold be the ideal hedge? David, please.
Thank you, Sri, and I hope everyone's hearing me clearly. How is the sound, Sri? Sounding good there?
Sound is very good.
Okay, excellent. And a warm welcome and good evening to everyone joining us for this webinar where we explore an interesting question. Gold. Okay, gold actually is one of the favorite investments a couple of years back, some 2 years back. I remember gold was a very, very hot topic in year 2020. At that time, of course, all of us will remember we went through the initial stages, the initial year, the first year in the pandemic. Okay, markets were suffering, equity markets were suffering, commodity markets were in a turmoil, and then on the recovery, we saw gold make a fantastic run up above 2,000, right? And a lot of people were excited about it. Okay, got back in, and then this recently, of course, this year as well, you saw gold run up again. And now the thing is, all those who have gone into the market buying gold, of course, a bit, what do you call that, disappointed with the underperformance of gold. as of today. Okay, so the thing is this: the question is always people have been saying that traditionally gold has been a very good hedge in inflationary times against inflation, right? So traditionally, people have said that. We were going to consider all those things about this particular traditional belief or traditional things that said about gold. Is that really true? Okay. Is what you're seeing now in terms of everybody's talking about very high inflation situation all around the world, but gold is in some ways or in most ways underperforming. Why is that? Okay, so we're gonna look at all those key drivers of gold, okay, and to see whether, say, in the next couple of weeks or in the next couple of months, what are the things that can actually drive gold prices, whether downside or whether gold will be able to take a launch pad from current prices to move up higher. All right, so we're going to talk about that. As Sri has said, any questions do put into the chat group or the Q&A section. We will take it at the end of the session, right? So let's move on. Okay, this is a quick disclaimer. Presentation is for your general information. Okay, it does not constitute a recommendation or an offer to buy or sell the derivatives. Okay, if you do want to act on the ideas that you see today, please talk to your licensed intermediaries in Phillip Capital. Right, basically that's the gist of this disclaimer. All right, let's move on. Okay, profile, Sri has covered that. Very well done. Thank you for covering that. And today, this is the evening's session. All right. So overview and outlook of gold price. Okay. What are the key factors? Okay. The main factors that are really moving gold prices or not. Okay. So we look at that. And very importantly, also, we want to look at what is the technical reading of the current phase of the market. So the current phase of the market, what phase is this? Is this the end of the downtrend? Is this the beginning of an uptrend? Okay, we want to know which phase. Okay, so of course depends on what time frame you are trading or investing in gold. Okay, we'll look at various time frames, weekly charts, monthly charts, and we look at that and see which phase are we on. Okay, so that you can strategize if you are going to go in, if there's any more downside with gold, or it's already on a recovery. Is there an opportunity to position yourself for the next trend? Okay, so during this particular what do you call that session, we'll talk about the technical reading. Okay, so with that also, of course, the potential price directions for gold. Okay, later, of course, knowing some of these scenarios, what are the ways we can take advantage of these moves? Okay, how we can use CME Group or gold contracts to take advantage of this trend, and how to use that to add gold into your portfolio. All right, so let's move on. So let's first, what do you call that, compare gold against the rest of the assets. Okay, what you see on this page is a glance of all the major futures contracts, okay, which covers all types of assets, financial instruments, what do you call that, commodities, currencies, and all that. And of course, as you can see right on top, which is this year-to-date performance as of 9th of October. Okay, you can see basically right on top, of course, energy, right? Everybody knows the energy has been right up there, okay? Natural gas, heating oil, and all that, okay? But if you see gold, okay, just look at gold. Gold is right in the center, okay? It's neither going up nor is it really going down very severely, right? As compared, of course, to the rest of the equity markets, you can see right at the bottom there, okay, as of 9th of October, you see the Nasdaq all down quite a substantial bit, S&P down quite a substantial bit, right? So of course, anything that's a non-dollar currency is also quite heavily not doing very well. US dollar, of course, is the main what do you call that, star in the last 1 year to date as well. So in terms of looking at this whole picture of all the types of tradable assets and instruments, gold seems to have actually not done that bad in terms of the sell-off, right? It basically has survived it, okay? Comparatively, it's just down slightly, okay? Against other risk assets like equities, okay? Or even if you're holding things like bonds, okay, that has not performed as well, okay? So we want to see why, right? It's relatively being quite okay in terms of you look at relative performance against risky assets. Okay, and why has it held its strength? Okay, maybe there's some underlying reason why it has done that. Okay, so let's look at the next slide. Okay, this is a comparison, okay, in terms of year-to-date percentage performance as of 11th of October, right? So you can see over here, gold in terms of the percentage is really actually has performed the 10-year notes. Of course, bonds have had a very hard time with the interest rates going up, okay, and as compared to the S&P as well, right? So in this chart, as of 11th of October, right, gold is just down 7.5%, and the Treasury notes 10 years are 15% down, and the S&P is down almost 25%, right? So relatively well. What are these implications, okay, of this underlying strength? Be able to what they call that to weather this storm, okay? So we will look at the different factors as we move on. Okay, so key fundamental drivers. Okay, of course, there are a lot of fundamental drivers in terms of gold supply, demand, and all that. Okay, so traditionally, supply demand is something, of course, that has been the underlying drivers. But we want to look at a lot of the other factors, the overwhelming factors that have been in play for the last 1 year. Okay, of course, not the conflict. Okay, which is the main topic you want to talk about today. Whether geopolitical tensions is one of the big factors where you should have some gold in your portfolio so that you can, hedge against this type of geopolitical risk. Okay, the inflation. Okay, this main topic as well. Inflation has been up. Why has gold not really performed yet? Okay, we're going to look into that. Global economy, of course, recession. Everybody's talking about the recession already coming in. Okay, some say, of course, in the US it's already in. Okay, and in terms of looking at the economic situation in the eurozone, things aren't really looking that well as well. So we'll look at those factors as well. And of course, US dollar. Okay, the main actor in this year's drivers in all types of different types of assets, and of course interest rates. Okay, so these are the big topics that we will be talking about. So in terms of looking at the US inflation, okay, straight off, let's talk about the US inflation. The numbers came out just recently, all right? You could see that actually the September numbers was 8.2% in terms of the annual inflation rate. And this was like, okay, it came off from the, what do you call that, the high of 9.1%. Okay, so but one of the things is this: the core CPI, which basically you remove the volatile energy and food prices, is up 6.6%, right? And this is highest since August 1982, and this was actually above market expectations. Market expectations about 6.5%. Okay, and this basically says that although we see the annual inflation rate slowing off and what do you call that, moving off the 9.1%, so the last 3 months have been 8.5, 8.3. 8.2 slowly coming down. The core, what they call that, CPI, okay, has actually been staying very, very elevated. Okay, so in sense, U.S. inflation still continues to be high, right? And in the next, what do you call that slide, you will see, okay. Of course, this is the what you can see here is the inflation rate of the U.S. and since 1980. Okay, so this is a long-term 42-year chart. Okay, so you've seen basically in terms of the inflation is has been very high, and this is the high of the last over 40 years. Okay, so in terms of this particular what do you call that factor, inflation, okay, so has it peaked? Is 9.1, the highest we have seen? Okay, or is it something that we are going to see even higher than that? Okay, so so a lot of experts and a lot of pundits in the market, of course, have been debating this question whether 9.1 is where we've seen peak inflation, and then we are going to have slower and slower numbers coming in, or is it a popular delusion of people trying to delude themselves, hoping and praying that this is actually have seen the worst of it? Okay, so now a lot of things you can see is there are a lot of factors, especially things like wild cards like oil prices. Okay, oil prices have been, of course, one of the main what do you call that, strong movers of inflation, energy prices and all that. Will oil prices continue to trend lower, or is it already bottomed out? Okay, recently you could see that the OPEC Plus has what do you call that, uh, reduce, what do you call that, refuse to increase their production. In fact, they cut production by 2 million barrels a day, right? Basically wanting to keep the oil price at a certain level, $90 per barrel and above, right? So are any other factors, are the geopolitical situation, the conflict between Ukraine and the conflict will other parts of the world, okay, be joining in terms of other flashpoints? Will that happen? Okay, and if that does happen, right, oil prices are going to fly again. Okay, and then of course with the oil prices flying, then inflation will start to climb again, right? So these are the certain wild cards that we will have to see in terms of the inflation. Okay, what we've seen over the last 1-2 months as well, the very extreme weather. Okay, we've gone from floods from certain parts of the world, and we've got drought in certain parts of the areas in the US where it's impacting the food crops, right? In Argentina, in the US, drought has become a very big factor. And with this again, you know, it has what do you call that, a very big impact in commodity prices. Okay, and if commodity prices start to rise again, you know, inflation may start to climb. Okay, so in this sense, in this particular slide, we are basically questioning whether, okay, inflation is going to get lower or milder, or is it going to have a new high? And this is just a short breather before things start to go higher again, right? So all these wildcards that you see, oil prices, escalation of geopolitical tensions, extreme weather patterns, okay, if these things get worse, then inflation may continue to just lift off the high and continue to move up. Okay, so this is something that we really have to look into when we are what do you call that, trading gold. Okay, and of course, inflation is something that will actually be helpful or supportive of gold prices, right? So let's move on and talk about other factors. Okay, so this question about gold, okay, as an inflation hedge. Okay, if we look at the recent times, okay, and we're looking here a chart of gold prices and the inflation from 1984. Okay, we have seen areas where, okay, gold prices actually come down when inflation go up, right? In this particular time, you could see, right? And here as well, in the 1996 to 1999, you know, when inflation actually, sorry, in 1997, 98, when inflation actually went up, gold prices went down, right? And when inflation went down, gold prices started to climb, right? So here, of course, it's a bit more correlated in terms of year 2000 onwards. As inflation rates went up, gold prices also climbed. Okay, there are other reasons which we will explore afterwards. Okay, so in this particular area in 2008, you could see that actually when inflation went up to very, very high, gold prices actually dropped. Okay, so in terms of looking at the pattern, they seem to be very mixed. Okay, so although the traditional long thought idea that go as an inflation, okay, so maybe the idea, okay, later we'll go in a bit more back into history and see why that particular idea of gold as an inflation hedge came from. Okay, so, and we'll see whether that particular kind of scenario is going to repeat itself in the near future, right? Okay, let's move on. Okay, U.S. unemployment rate, a very important part as well. Okay, in terms of measuring inflation and its impact on the Fed's decision on interest rates. Okay, what we see here are strong numbers. Okay, so the latest number that came in still very, very strong in September, 3.5%. Okay, so basically, I mean, the unemployment rate is low, so employment is very strong. Okay, and basically, in terms of looking at this is only matched in to the 3.5% in July, and this is the lowest since February of 2020, right? So in terms of that, if the employment numbers in terms of jobs are still very, very strong, then that basically feeds into more people thinking that the Fed will continue their bigger rate hikes in the horizon. Okay, so you may see as the numbers still continue to be strong, and the Fed is going to continue to raise rates. Okay, so that has of course related to gold prices. We have to see rates are very, very important in that sense, impact of gold prices, right? So let's look at US dollar. Okay, this is the what do you call that, the big guy, the guy that's been controlling all the headlines over the last this 1 year. Okay, so in terms of dollar strength, you can see over here, which is the blue line. All right, that is the biggest driver currently in terms of gold prices. Okay, and as the what do you call that, the dollar, this is the dollar index, the US dollar index, as it continue to climb. Okay, you will see gold continue to be pressured. Okay, so now the key thing is this, right? Since US dollar is such a huge determinant of gold prices, then we will have to check to see whether the US dollar is starting to top in terms of its strength. Not if it's topping off in terms of its strength, then you may see that particular time where the gold prices are going to change direction. Okay, as it is, the current chart you can see is still very strong. Later we'll go into the dollar index and see what's the trend as well, and look at the phase as well. Okay, because basically the things aren't really looking that great in the eurozone, so you get a lot of capital outflows right from the eurozone crisis. They have an energy crisis over there. Okay, the Ukraine Russian conflict is so near to them, right? So this is basically you see capital outflows out of eurozone into the US dollar. Right. Of course, the Federal Reserve aggressive rate hike also to contain inflation also continue to push the US dollar exchange rates higher. Right. So in terms of basically investors looking to safety, flight to safety, okay, the US dollar is a natural choice to put your money in, right? And that's why you see the pressure, the upward pressure on the US dollar, right? As it is, it still continues to be strong. Later we'll look at the technicals to see whether there is a chance that it may come down, right? So later we'll have a look. Okay, so in terms of the global economy, okay, things aren't really that good according to the IMF. Okay, they issued this World Economic Outlook update in July. Okay, basically in their eyes, there's going to be a very strong global slowdown. Okay, the global slowdown is going to intensify. Of course, reasons are well known. The war in Ukraine, okay, the disruptions in the what do you call that, supply chain feeding into inflation. Okay, and that time, of course, when they did the report, the renewed COVID-19 outbreak, especially in China, right? And because China had this or have this zero COVID policy, okay, that is going to suppress the growth of the economy in China, right? And of course, the geopolitical fragmentation. Okay, so markets are getting fragmented, and this is not helping in the global economy, right? So in terms of looking at the numbers of IMF, basically they're not very positive, as you can see over here in terms of the picture for the global economy. 2022 they look at 3.2 and 2023 at 2.9%. Okay, so a rather pessimistic look in terms of how the IMF see the global economy going in the next 1 year. All right, so to them, they feel that the risk is basically overwhelmingly tilted to the downside. All right, so what even in terms of their very pessimistic view is growth will be in the bottom 10% of outcome since 1970, right? So this is like not a very good scenario, and we haven't seen this since the 1970s, right? So that's IMF for you. And of course, the World Bank also came in with their report, the mid-year report, and basically downgrades the expectations of global growth to 2.9% in 2022. And basically what the World Bank says is recession is unavoidable for many, many countries, all right, because of the high inflation and also the slow growth. What they see basically, okay, is this word called stagflation. Okay, you've seen this word being flashed around a lot these days, stagflation. Okay, basically you have very low growth or even no growth, okay, but the prices and inflation are still staying very high. Okay, and the problem with stagflation is stagflation doesn't have easy solutions in terms of the central banks. They don't have an easy answer to this, right? So this is going to be something that the World Bank sees will persist over the next several years. Okay, so remember, of course, the situations are not really that good in terms of the global economy. But what is the impact, okay, of this word stagflation on gold prices? Okay, so we're of course taking all these factors in relation to the gold prices. All right, so let's move on, and let's look and revisit the last time stagflation was experienced in the world, and that is in the 1970s. Okay, that's why I say, oh, sorry, we're going to rewind back some 50 years and talk about stagflation, because that was the last occasion the world saw stagflation. Okay, and this could be where the rise, the what do you call that, the traditional notion that gold is a very good hedge for inflation. Okay, so what is stagflation, and what actually makes the ingredients of stagflation? Okay, the first is of course stagnant growth. Okay, that's the stag part, is the stagnant growth. Okay, so in terms of looking at the US GDP growth in 1973 to 1977, you can see this chart over here. Yeah, the what do you call that? Basically, U.S. Growth was negative, right? So in this year's for the peak in 1973 and coming down to 1975, U.S. economy was stagnant, okay, and down, very low, and of course in negative figures as well. All right. So number one ingredient, stagnant growth. Okay. Number two ingredient is inflation and unemployment. Okay, so this figure you will see here is basically the what do you call that? The green or the blue, depending on your screen, is the inflation numbers. Okay, so you could see in the years in 1973 to 1975, rising inflation. Okay, and rising unemployment. Okay, so things were just bad. Okay, so people couldn't find jobs, right? And inflation was rising. So you have these three ingredients that what you call it, describes stagflation. Okay, in the 1970s, right? So in the 1970s, how were the gold prices? Okay, so let's look at it. Okay, so in terms of looking at okay, before we look at the relationship with gold, then let's look at why in the 1970s they had this stagflation. Okay, basically the catalyst was again very interestingly 1973 oil crisis. Okay, at that time WTI spiked in January of 1974. Okay, US recession from 1973 to 1975. Okay, and at that time you had high oil prices, which means high inflation, and also the economy wasn't growing. Okay, now this oil crisis thing, right? Is this something deja vu now? We have a situation of an energy crisis. Okay, we are looking at the world going into recession. Okay, and with the what do you call that, World Bank pronouncing stagflation will persist in the next couple of years. Okay, so this is like a deja vu. This is like a rerun. Okay, some people may agree, or some people fully agree that this looks like a situation in the 1970s again, right? Now, this is actually crude oil price. You can see the spike. Okay, between real WTI price and actual nominal WTI price adjusted for CPI. Okay, this is of course a long-term 20-year chart. All right, so it was basically catalyst was a 1973 oil crisis. Right, and in terms of looking at the gold prices, okay, as you can see over here, 1973 is 1975. Okay, this is the price of gold. Gold actually hit spiked up, okay, during this period. Okay, and the gray areas are the recessionary times. Okay, very slow growth, very stagnant growth, recessionary trend. And it seems that from looking at this chart that the gold tends to perform well during recessions. Okay, not to mention stagflation. So if looking at this situation, if the world goes into, say, in the next 1 or 2 years goes into stagflation, then it will be very supportive in terms of the gold price. Okay, so this is just a case for thought. Okay, the last stagflation was in the 1970s, and this is how gold has performed during that particular time. Will it repeat itself? Well, it's something that we will have to see, right? So geopolitical tensions, okay, is this no longer a wild card? Okay, this is something that used to be a wild card, okay, but things don't really look that great. If we have been following the news on the conflict between Ukraine and Russia, things seem to be getting worse, okay. Of course, we all hope for peace to prevail, but the things really don't look that good at this current moment, right? So is this going to spread to other parts of Europe? Okay, is this going to escalate? Okay, this World War III word has been seems to be so common these days. Okay, everybody's talking about this particular word. Okay, across news, across if you follow news on YouTube or even on online, you see this word being bandied around, right? A nuclear. Strategic nuclear weapons being used. Is this going to happen, right? This is, of course, going to be a very, very what do you call that? A severe impact on the world, right? The other parts of the world, the Taiwan issue, right? Is this going to be the next flashpoint? Okay, already things are moving towards not a very what do you call that, happy situation in Taiwan. Okay, so the things happening in that part of the world, is this going to become another flashpoint? So this is something that needs to be really looked at. And of course, in terms of the impact, okay, on gold prices, it has a significant impact. Okay, next slide will show you why. Okay, we will what do you call that, explore, okay, geopolitical risk effect on gold, okay, because instability actually drives gold prices. Okay, so if you've heard stories last time during the Vietnam War and all that, people used to carry their wealth in gold bars and all that, right? So in terms of the gold's price what do you call that, reaction to geopolitical risk, okay, it does react to geopolitical tensions and war, okay, because in terms of safe haven, okay, a hedge against all this uncertainty, gold is and precious metal is one of those things that people actually go and buy, okay. And if you look at some of the research that's been done, okay, I reference here a research by Dirk Bauer and Lee in 2020, okay, whether hedging GPR or geopolitical risk with precious metals actually work. Okay, basically they found that there is a very strong correlation, and there's a gold and silver has consistently as a strong hedge for even normal GPR or normal geopolitical, and also a safe haven during extreme periods. Okay, so if things are going to turn bad in terms of geopolitical tensions, okay, then there is a very strong what do you call that, reason, okay, that gold prices are going to be driven upwards. Okay, so these are some of the very recent in year 2020 this research they studied whether it is a very good hedge against geopolitical. So the word is it has a very strong correlation and has consistently performed. Okay, and what is interesting about this is the strongest move in terms of gold, okay, when it comes to the geopolitical risk is when things are what do you call that, in its initial stages, when things are boiling, and not when the event actually happens. Okay, so this is something that you want to so it's like buy on when what do you call that, news is not confirmed yet, and then when it's actually confirmed, then prices will soften. Okay, so this is an interesting part of that particular research as well. So if you're free and you get a chance to read it online, you can go to this particular research and see what are the findings. Okay, but as far as that finding is concerned, is definitely a consistent and strong hedge for geopolitical risk. Okay, so what is the next thing? Okay, so in summary, okay, stagflation is in the picture, right? So if you are going back to the 1970s time, so that would be a strong case for gold. Okay, are geopolitical tensions going to rise or escalate or spread to other parts of the world? Okay, if that happens, okay, if this World War III being bandied around, is this really going to happen, right? If all these things are going to happen, then of course the case for gold is very, very strong. Okay, so in terms of the things that's been hitting the headlines and been impacting the price, okay, these are the things that you have to keep continued monitoring of all these factors, right? So now we move on to look at the technicals. Okay, let's see what the technicals say about gold prices and its trends. Right, so reading the current phase of the market, I will use, as usual, the study of Elliott wave analysis to see which phase we are in. Okay, so first let's look at the corrective. Okay, futures, gold futures monthly chart. Okay, now the last since year 2020, every time gold prices turn down, okay, it has been able to be supported at this particular level. You can see this dotted horizontal line over here. It has always been supported by this key price. Okay, so we have one support here basically in 2021, okay, rebounded up, okay, came back down in late of 2021, again retest this, but able to rebound and actually go back up above 2000. Okay, and then as it came down towards this year, everybody was hoping that this particular what do you call that support will hold. Okay, but of course this crucial support, you saw the last couple of weeks that it was breached. This is the 1675 support, a very key support was breached. So basically it's pointing that it's going to go in the sequence of a bearish trend. All right, so now this particular consolidation, okay, if you look at the phrase, this is a classic 5-wave uptrend. Okay, since even before 2006 the trend started already. Okay, so the strongest wave was actually this particular wave from 2008 onwards until around 2011 we did a high. Okay, and then it came back down on a consolidation. Okay, this is where everybody got in as well, and then always after they get in, they get disappointed again, the prices start to come down. Okay, and this is actually a wave 4 consolidation on the monthly chart, and then it started to what do you call that, flatten out. Okay, so this time was a very frustrating time for those gold investors. Okay, so it was just basically moving around 1004 and then 1001. Okay, and then move up to near to 1004 and come back down. Okay, below 1002, and ding dong, it's been there, almost so boring for this from year 2014, okay, until another like 5.5 to 6 years. Okay, and then only when it broke this top, okay, around the 1380 levels, then you saw gold started to climb, and this is actually the 5th wave. Okay, so the 5th wave is actually the last up wave for this for this bull trend. Okay, so where it topped out, okay, somewhere right over here at the 2000 near the 2001 level the first time. This is actually the 5th wave in terms of the monthly chart. So if you see this 5th wave, that means that it will go into what we call a consolidation. Okay, you have a corrective wave down. Okay, and this corrective wave, okay, normally when it comes down in terms of the monthly chart, okay, basically in terms of monthly chart, the trend is basically for the next, say, 1 year or 1.5 years. Okay, so from this start over in 2020, slightly in 20 near to 2021 where it came down, okay, you'll have another 1.5 years or 2 years of consolidation. All right, and you could see it break its 1675 levels. What's the next area? Okay, so normally when you have this correction, normally it will land in this zone, which is the wave 4 zone. Okay, so wave 4 zone is between 1050 to 1380. So this is the previous consolidation range, okay, which is spent some more than 5 years in. Okay, so this is where it, particularly if it goes down, this could be where you will find support again. Okay, and from there gold could possibly then see, if it's a very long-term view, another new up wave. Okay, so but that is very long term. We are talking about a year or a year and a half. Okay, so let's see in terms of the weekly chart what we have. So this is a long-term chart. Okay, so basically in long term we are seeing a corrective move downwards. Okay, but in terms of the weekly chart, what are we seeing? Okay, so I think very similar to the what do you call that, the monthly chart, we are going to see it break down into what we say ABC corrective wave. Okay, so currently it's also a fifth wave already finished. Okay, in fact, it failed to move above the third wave. So this sequence on the up wave is finished. Okay, this 5 wave is part of that 5th wave we saw on the monthly chart, and so this ABC we are looking to see that it's what they call that it may come down to this this levels to the 1050 to the 1380 region. Okay, but expect some prices to go up at this particular leg, which is the B wave. Okay, so B wave, you could see prices still continue to do one leg up, but this is not expected to move above the 2000 price. Okay, so you probably be looking at a retracement up to 50% or 62% of this particular move. Okay, so close to probably the 1009 levels. Okay, you could still see, okay, possibly if it works out, possibly in the next couple of weeks you may have a technical rebound to higher prices. Okay, so that's what we see in the weekly chart. What do we see on the daily chart? Okay, let's see. Daily chart is interesting. Okay, daily chart, what we see is bullish divergence. Okay, so basically in terms of the daily chart correction, okay, it's done a sequence of 5 waves. Okay, so this is the bullish divergence, which is basically suggesting that this particular down wave will have a technical rebound. Okay, if you can hold this 1620 lows, okay, currently it's trying to retest. Just when I updated this chart was 1634, this low is 1620s. Okay, so if you can hold this, then you will see a sequence of up wave will be will coincide to the previous chart, which is the B wave. Okay, so B wave is an upward wave of this corrective wave. So you could see it developing this way because as far as the daily charts are concerned, the momentums are basically saying there is a bullish divergence and a possibility of a technical rebound coming up from here, right? And this technical rebound, if it forms and it goes up, then there is a projected target of 1825 for this particular move, okay, which is the top of this wave 4. All right, so that's something that possible. Okay, with there are signs on this chart that we could see a momentum or a rebound coming in the near, quite near, in the say the next 20 days. Okay, basically daily charts you multiply by the time frame you're looking at. So in the next 1 month, you could see a technical rebound. Okay, so that's what the daily chart is saying. Okay, so let's go in and look at the key factor that's been effective affecting gold prices. Okay, the dollar index. Okay, so basically in terms of the weekly chart, the dollar strength is still there. You can see the momentum continue to move up. Okay, earlier last year, I think, or beginning of this year when I did this, we saw some weakness, but the strength continued to move on. So this is basically a very aggressive extended wave 3. Okay, wave 3 is of course the strongest wave of an uptrend. Okay, so it continues in terms of the weekly chart. Okay, to have strength. You can see the momentum are still in the green. Right, so it has moved into an extended target zone. In fact, this target zone is where it possibly could actually do a correction. Okay, so we will have to see, and in that we go into the daily chart and see whether there's a possibility of that. Okay, so let's move in to the daily chart. Okay, this is a 2-day chart. Okay, because the 2-day chart shows this better. Okay, so we have wave 1 followed by a correction in wave 2. Okay, and then we have a wave 3. Okay, this going, of course, is the same as the weekly wave 3, same sequence. Okay, but what is interesting to see is this: the prices are going up, but the momentum is weakening. Okay, basically momentum is coming down. Okay, and this in the classic technical analysis is called a bearish divergence. Okay, so possibility of a what do you call that, the dollar taking a rest. Okay, this is a 2-day chart, so possibly in the most important price you want to see is this 110. If you see the US dollar index, okay, if it doesn't go and clear a new high, if it comes down and breach the 110 levels, okay, then there's a possibility that you can see a US dollar do a correction downwards. Okay, but it's still on a upward trend. Okay, but this is the typical wave 4 correction. Okay, and wave 4 correction normally it will correct at least half of this wave, the third wave, which is from here, from 95 to 115, half of this. Okay, so basically half of it will be around the 100 or 102 levels. Okay, this particular level. Right, so there is a chance, because of this bearish divergence coming in, that the pace of the US dollar rise may what do you call that, be not so strong anymore in terms of the daily chart. Okay, so very important price point is the 110 to look at. All right, so let's move on and see how we can take advantage. Okay, so in conclusion, you can see that in terms of the next 1 month chart, we possibility of seeing gold going up. Okay, but in the longer term, there's still the bearish chance of it going down to test the 1050 to the 1380 levels. Okay, so if you're trading those, okay, how can we take advantage of this particular possible price directions? Of course, using CME Gold futures contracts. Okay, so of course the most famous gold contract is this GC, right? This is basically the world's leading benchmark futures contract in terms of gold. Okay, it's a 100 troy ounce gold. Okay, a lot of you who have traded gold, this is the very familiar to you. All right, trades almost 24 hours. Okay, and basically in terms of Asian hours, a very active contract. Okay, about 40% of the volumes are actually executed during Asian hours. Okay, currently the year-to-date average daily volume is about 221K. Right, of course off from the peak on 2020, but still very, very strong volumes actively traded on a daily basis. Right, so this is the main gold contract. Okay, GC. Okay, but what we have, okay, for the smaller investors or the retail investors, you can see for gold, if you trade one contract of gold, this 100 troy ounce gold is 5,007 in terms of the margins required. Okay, so this is the exchange margins. Please talk to, of course, to Phillip Capital on what is their current margins, which they are charging. It's basically around here, right? And it's not a very cheap contract to trade, of course. Okay, but we have good news. Of course, we have the micro gold. You can see over here. This is a smaller contract. Okay, it is 1/10 the size of the GC. Right, so it's 10 troy ounce. It's a more affordable way, okay, of trading gold or getting yourself into gold. Okay, very convenient in terms of the size. But of course, if you build up a size of more than 10, you can also offset this with GC. So if you have 10 contracts of micro gold, you can actually offset with one contract of the GCs. Okay, so quite active as well. About 52,000 contracts are traded on a daily basis, right? And you can see over here the margin requirements are much less. It's a 1/10 of the requirement. So for the exchange at the clearing level, is charging about 570 US dollars for a contract. So it's relatively affordable in terms of trading gold, right? And if you look at it, there is of course, when you're trading the gold futures contract, you're talking about the leverage, right? So how much is 10 troy ounce of gold? Let's say, for example, if gold now is trading at 1,600, okay, so 10 troy ounce would be 16,000 US dollars worth of gold, right? And you're using 570 US dollars to trade, okay, 16 what do you call that, 16,000 worth of gold. So that's leverage for you. Okay, so that's the advantage of trading futures contract, of course, is the leverage. Okay, so let's look at a few examples of if you buy and sell gold, how does it look like? Okay, so here's an example of trading a bullish market. Okay, so if you have in your mind that, oh, wow, okay, the next couple of weeks, if my signals on my chart show that it's buy and it's on the same phase as a technical rebound for the A wave, for the B wave, then you say you go long gold. Okay, for in this example, it's 1,007. Say you buy a December gold futures contract, and of course GC is a 100-ounce contract. You buy it at say 1,007, right? And if it actually moves up, okay, just now we're looking at gold possibly moving up to a projected target of 1,805. Let's say, for example, it moves up to 1,750, right? So basically, you have for each contract, each ounce is 50 US dollars. It's a 100-ounce contract, so 50 multiplied by 100 is a $5,000 gain, right? That's quite substantial, right? Of course, the margins at this current moment is 5,007, but making 5,000 using a margin of 5,007 is also a very powerful use of leverage. Of course, things don't necessarily have to move your way. Okay, sometimes market don't move the same way as you project. Okay, so if gold drops to 1650, then you have a loss of $50 per ounce. Okay, multiplied by 100 ounces, then you will have a loss of 5,000 as well. Okay, so this is something you need to keep aware. So in terms of trading futures, of course, always able to manage. Okay, make sure you have stop losses and all that to manage in case your view is wrong. Okay, now if you go short, if you believe that in the longer term, gold is still on the downtrend, then you can actually go short. Okay, and this example is for the MGC, the micro gold futures contract. Again, 10 ounce contract. Okay, remember it's a smaller contract. You go short. Okay, and it's, for example, you go short the December micro gold at 1,007. Okay, and if it goes down, okay, going short, that means you have the view that the market is going down. And if micro gold trades to 1650, you have $50 per ounce of profit. Multiplied by 10 ounces, because it's a 10 ounce contract, then you have $500 gain. Very handsome as well, right? Your margins are only 570 US. But of course, if prices move up, then it will be against you. And if it moves up to 1750, then you have a $50 per ounce loss. Multiplied by 10, you have a $500 loss. Okay, so that's how. It's very simple actually in terms of trading the P&L, right? So this is an example of showing you how if you are in a position, whether long or short, if market goes for you or go against you, how the P&Ls are calculated. All right, so let's move on. Okay, I would like to recommend you this very good newsletter. Okay, this newsletter is written for CME. Okay, it's called the Trading Room, and if you have, you can scan this particular T-Rex here, or you can go into the CME website, go to Fresh from the Trading Room. You get this newsletter. Subscribe for it. You come in twice a month into your inbox. And actually, the latest issue on October 12th, if you go there and read, the topic is, does gold still remain an inflation hedge? Okay, so simple. Go in, subscribe, and see what's the view, right? Of course, this not only covers gold, it covers all types of CME contracts, from commodities to interest rates, to equities and to crude oil and all that. So a lot of interesting trading ideas, actionable. You can actually use those ideas as well for your trading ideas, right? So do join this particular newsletter and log in to see what they have to say about gold in the October 12th issue. Right, so I'm going to go into live charts. Okay, so if you have any questions, you can prepare them, and we'll do the Q&A with Sri shortly. But let's go into live charts and see what's been happening in the gold market now. Okay, just quickly, let me go here. If you have any questions on the charts as well, do put it in the chat group. Oops, sorry, wrong. Okay. You should be able to see the gold chart now. It should be loading. Okay, meantime, while we are waiting for this to load, put up your questions and we'll be very happy to get to them. Just wait for it to connect to the price server. Okay, there you have it. Okay, so in terms of, this is the daily chart. Okay, so situation is still being defending the 1620 levels. Okay, this is the 1620 levels. You can see right here. Okay, I hope you're seeing this. Okay, so let me go in and see whether I can get you the shorter term hourly chart. Okay, let's go to an hourly chart to see what we have for today's intraday action. Okay, just let it for a while. Okay, so this is the hourly chart. All right, so in terms of hourly chart, we also see a bullish divergence. Okay, the prices are coming down, but the momentum is going up. All right. So okay, what he has done across the last 3 hours is come up above this particular price. Okay, this particular price is the 1639 level, so it's traded above that. Okay, so for the shorter term, it's what we say is broken above this particular up fractal, so prices are expected to move up higher. Okay, if you can go up above this tree line, these three lines are the Bill Williams alligator, right? So currently, the last in the morning has been consolidating, but it managed to break out of this particular intraday range. Okay, so it seems that it's possible to see it go up higher. All right, where's the next target? Of course, the next target with all these down fractals, the 1650 levels. Okay, but that's still a good $9 away. Okay, so this are possibly day trading opportunities as well. When I trade gold, I actually trade it intraday. My favorite time frame is the hourly chart. Okay, that's why I look at the hourly chart. So in terms of the hourly chart, it's basically saying, okay, what is the trend in say the next 20 hours of trading. Okay, so at this particular moment, it seems that it's inclined on the upside. Okay, basically breaking up these two up points, right? So in terms of weekly, I think the pictures are of course all the same as well. Okay. Okay, same weekly, all the same. Okay, so that is one of the intraday charts for you. Let's go to Q&A. Sri, if you see any questions, let's move to that while I'm on this particular screen. Sri, back to you.
Hey David, all right, it's time for the Q&A right now. First question is from Sam. He's asking, is gold suitable for intraday trade? If yes, what would be the strategy that you would recommend?
Okay, excellent question. I just hinted to you. I do trade gold and I love to trade gold on an intraday basis. Okay, let's just go into, say for example, let's go into a 30-minute chart. Okay, and let's see what are the, okay. But first, let me just talk about the strategy of trading gold. Okay, I'm going to put down the ATR chart for you to have a look. Okay, so in terms of the ATR, okay, so the average true range, okay, some of you are familiar, basically defines in any particular time period what is the movement that can be expected. Okay, so if you are trading a 30-minute chart, okay, so in the active hours, which is around what call that where we are now, okay, it trades about $3 to $4 US. Okay, so if you are trading a micros on what call that for gold MGC, okay, then you are expecting that in when you're looking at the daily hourly chart, okay, sorry, the half hourly chart, okay, we're looking at the half hourly movement about $3 to $4 what do you call that $3 to $4 move. Okay, so when I trade, basically if you ask whether it's viable to trade intraday, you have to go in and look at the volatility on that particular time frame. Okay, so for 30 minutes, you have a possibility of a $3 to $4 move, which is actually very, very decent. Okay, so I like the hourly charts even for day trading, and for hourly charts, you have an ATR, okay, around the $4.5 to $5. Okay, so it's a very, very decent move. Okay, because on the daily move, if you look at the daily move for gold, okay, even if you say gold is basically less what do you call that volatile than the rest, like compared to crude oil, but even you could see on a daily basis, gold has a very big move. It has something like a 20 to 27 to 29 dollar range on a daily basis. Okay, of course volatility has come back in a bit. Okay, from 20th of September. Okay, for the last 1 month, you can see the volatility has increased for gold. All right, so it is a very, very decent range actually on a daily basis. Okay, so and I like gold because of course gold, you have to watch when those big data numbers come out, inflation numbers, labor, what do you call that, employment numbers. Those dates I will try to avoid to trade because you know, when the numbers turn up, they tend to be very high volatility. But the rest of the days, the trends are quite what do you call that, quite steady, and quite in what sense is quite stable to read. Okay, so in terms of trading gold on an intraday basis, okay, look for say a 30-minute chart. For me, a 30-minute chart or a 1 hourly chart to look at the trends, and I normally trade the breakouts. Okay, I'll trade those fractal breakouts. Okay, I'll take trades around here. Let me show you one. Let's say, for example, if I'm trading a 30-minute chart, I would go in and trade this particular. I'll look at this particular point. Okay, let me get you a horizontal ray. Okay, so my entry points will be right over here. Okay, right over here, which is the 138, 138 or 139 levels. Okay, that will trigger a buy for me in terms of a fractal breakout. Okay, and you could actually get quite a decent trade if it's the high here is how much? The high here is 43, 44. Okay, so you went in at about 39 and you got like a $4 to $5 trade over the next couple of bars. Okay, so very decent volatility as well, although gold is not, of course, not so crazy as the crude oils and other commodities, but this got very steady trends, which I like. So I hope that answers the question. Sri, back to you.
All right, thank you so much, David. All right, next question is from Tanglum Low. He's
Hmm.
asking, has gold been heavily shorted to support the dollar and the US economy? What are your thoughts on this?
Okay. So of course, in terms I look at charts and I look at what has happened. Okay. Um, in terms of what gold has done is actually quite admirable. Okay, so despite the huge sell down in all the types of risk assets, equities, and all that, as we've seen the first initial size, the strength or the resilience have been what do you call that, quite strong. Okay, because basically in terms of news flows, you talk about inflation and all that, the prices of gold actually intuitively should be stronger. Okay, so the question of whether it has been shorted down to a certain level, or if you're saying that some invisible guy is of very strong hands are pushing down or suppressing the price of gold. Well, some people talk about those theories. Okay, of course, nobody has a very conclusive evidence to say that. Okay, but as you can see, it broke the very important support 1675. Okay, and when it breaks that as well, if you are a technical trader, you will also go in on a short position. Okay, you also follow the trend. I'm a trend trader, so if it breaks that, I'm a short as well. So the pressure will pile up on gold if those technical points are basically broken. Okay, but as a trader, we look at the all those slides I shared with you, like things like stagflation and all that, all is very good to give you a very big picture. Okay, but when you are trading gold, when you're actually going to entry and exits, of course you would have a better way to gauge where your entry and exits are. Okay, so the big news and all those big headliners are basically background scenarios. Okay, so you can trade within that scenario, but you still have to find the entry and exit based on the method that you are trading. Okay, so if the method says, okay, it's a short, then we go short. We follow the method and we follow the system that we trade, and the time frame, of course, the time frame that you trade. Okay, so I hope that sort of gives you an idea of my opinion on that. Back to you, Sri.
David, this question is from Martha. Martha is asking, maybe you can give an overview of what is a 10-year treasury note and what is its relationship with gold and the
Mm.
overall economy.
Okay, of course, 10-year treasury notes, okay, is a matter of the interest rate play, right? So the thing is this, we have the Federal Reserve looking at a long-term goal of 2% for US inflation, right? And now you have the inflation, the latest numbers come in at slightly above 8%, and you have the current interest rates close to 3%. There's huge gap. There's still a very big gap in terms of the current interest rates as represented by the. Let me see whether I have a 10-year note. Okay, just give me a second. See whether I can pull out a chart on that. Let's see whether I have that or not. It'd be good to have that. Okay, so of course, interest rates and gold prices are inverse. If interest rates are going up, then gold prices move inversely, right? So and also, of course, interest rates move inversely to the treasury note prices. So basically, if treasury is going down, the interest rates are going up. So in terms of gold prices and treasury notes, they are moving in the same direction, okay, vis-a-vis the interest rate, okay. Let me see whether I have an interest rate thing. What do I have this? What is this? No, this is a Dutch thing, sorry. Let me pull up one chart. Okay, so the relationship is inverse. Gold price, of course, inverse to what do you call that, interest rates, and of course the gold price will move in the same direction as the treasury notes. As rates go up, the treasury notes will also go down. Okay, let me load the chart. Quickly bring that out. Okay, let's look at a micro yield. Okay, so micro yield is basically trades another contract traded on CME. Okay, this is one of the newer contracts as well. Very interesting contract and a very active contract as well. Okay, just give it a bit time to load. All right, so let me see. Okay, that's the 10-year yield. Okay, this is the micro 10-year yield, okay, representing the yield of the 10-year note. Okay, so as you can see, basically in terms of the yield of the 10-year note, okay, in this daily chart, okay, it's trading around currently is the 4.1 level, 4. Okay, let me look for a while. Okay, so it's currently trading at a yield of 4.132%. Okay, still looking at the interest rate, rather still on the strong side. Okay, of course you are expecting because the stance of the Federal Reserve has been aggressively hiking the rates. Okay, 75 basis points for the last 3 hikes. And what is the next hike? Okay, people are saying that possibility of maybe another 50 or another 75. Okay, now when you're looking at the next particular hike, okay, you need to know the next meeting for the Federal Reserve is on November 2nd, and then you have the midterms, the US midterms elections on November the 8th. Okay, now of course, raising the rates, okay, during a midterm elections is not something the incumbent administration would like, right? So you might see perhaps whether the Fed will be a bit more gentle in this November 2nd meeting and raise rates 25 basis points instead of 50 basis points or 75 basis points. Okay, so this is of course debatable. Okay, so whether that will happen. Okay, of course, if that happens, with that kind of a slightly dovish kind of view, okay, in terms of the interest rates, then you will see gold start to rise. Okay, so if you see a dovish move in terms of the Fed's the direction, then it's basically the timing for gold to rebound. Okay, so in terms of looking, let me just go through this is the micro 10-year. Let me go to the 10-year notes. Okay, and you can see the relationship. Okay, so this is the 10-year micro yield. This is the yield just now we saw at 4. Okay, that's the price. Okay, and then you have the 10-year note prices. So you see it's on the inverse. Okay, so I hope that answers the question on the relationship between the treasury notes and gold prices. Back to you, Sri.
All right, David, how do we identify gold is going from a reverse to an uptrend? What are your key indicators?
Okay, the key thing is what we spoke about just now. The key thing is look for divergences. Okay, so looking for differences in momentum, and what I basically look at. Okay, hold on a second while I bring up the gold chart. The first hint of a possible reversal is always this what do you call that? just let me remove this. Okay, always this particular trend. Okay, so you can see this. Let me draw a trend line for you. Okay, this is a 30-minute chart. Okay, so let me draw a arrow. Okay, so you see prices coming down, right? So you see prices coming down, and then you see momentum going up. Okay, momentum going up, right? So as prices coming, then you observe, hey, the momentum is moving up. That means the strength of the selling pressure is getting less and less. So you have prices coming down, but momentum going up. So this is, of course, the classic bullish divergence, okay? And then you could see here, after it does that, then I will look for a fractal breakout, the first fractal breakout, okay? So the first fractal breakout is where people don't believe that the trend is going to turn, okay? So it's going to do a low, go up, do a high, and then come down to a low. This is where people don't believe, you see? That's why prices go down, okay? But prices does not exceed the previous low, okay? This is a classic sign of a reversal. You have a bullish divergence and you have a fractal breakout right at this level, okay? So this one has already broken out, okay? Over here, it's already broken out, okay? Um, okay, this particular price point, this is the high is at 1639. Let's say, for example, 1640 is already broken out 1640. So in terms of the 30-minute chart, of course, this is a very short-term chart, and this is already on the uptrend, and this is the classic reversal, a divergence, okay, followed by a fractal breakout, okay, or a swing point breakout. Okay, so this is where you try to catch a particular reversal. You can never, of course, catch it right at the bottom. Okay, it's impossible to catch it at this price. Okay, well, there are some indicators that can let you do that. Okay, but normally the confirmation comes when it takes out this particular high. Okay, so in terms of identify a turning point in terms of gold, okay, you project this particular idea and take it over either to the longer term chart, whether it's weekly chart or daily charts, and you see whether these appear or not. So just now we saw even on the daily chart. Okay, so later, just let me go in on the daily chart just to recap what we saw. Okay, so we saw, you can see over here, okay, prices coming down, right? Prices coming down, okay, and then momentum. Oops, sorry about it. So let me finish this, okay, and then momentum moving upwards. Okay, so the bottoms of this are moving upwards. Okay, so this is a classic sign of a possible reversal. Okay, so what is going to confirm this particular price point is if it doesn't break the low and goes up and takes this particular high, 1738.7. If it takes this particular high out, okay, on this move, then you will have that particular wave of upward wave will come in at this particular price. Okay, so this is the key price now for the daily chart. Okay, 1738.7, provided it doesn't break the 1620 price. Okay, this particular price, right? So those are some pointers on how to look for a reversal point in terms of the gold chart. I hope that answers the question 3.
Yes, it does, David. Okay, maybe before we end the session for the day, to the members of audience, we do not have time to answer all the questions, but rest assured, I'll be sending David an email, and he will be giving his replies to them, and we'll add the replies in our follow-up email to you tomorrow, so you won't be missing out at all. All right, maybe before we go, David, this is a classic question. How does gold compare to silver right now?
Yes, 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 yes. Gold compared to silver. Okay. One thing is silver, of course, is a big contract as well. So a lot of people. Okay. Let me take out the chart. Let's have a quick look. Classic question, gold and silver. Silver is kind of a big contract to trade in terms of capital requirement. It's a very big contract, okay? Whereas gold, of course, is we have the micro gold, which is very convenient to trade. Yeah. Okay. I'm sorry. I will have to. I have a chart that has a dark background, which may be difficult for you to see. Could hold on a second. Okay, so let's see anything interesting. Okay, so you see silver on the daily chart is actually consolidated. Okay, it's since July, it's basically go on a sideways trend, right? So 21 is the key price. It couldn't break through. It came back down. Okay, and now at the spot line of 18. Okay, it's currently at trading around the 1860 levels. Okay, so the 21 level is a very key point to be able to trade above and then what do you call that move. But okay, so if your eye is trained again, you will be able to see the bullish divergence. Okay, if you can see it right over here. Okay, so do we have a bullish divergence? Okay, basically prices going down. Okay, and then you have momentum going up. So this is again a classic um, possible of a reversal. Okay, so where does silver start to really actually be able to move up? The confirmation will come when it's able to take up this particular high. Okay, so this high is at what level? This high is at the 21. Okay, this high is 21.31. Okay, so if you see silver prices trading above 21.31, then I think there's a high possibility that it's starting a impulsive wave upwards. Right, so that's a quick and dirty look for silver. I hope that helps to give a quick overview of where silver is. Back to you, Sri.
All right, thank you so much, David, for your insights and sharing today. And members of the audience, thank you for tuning in to our next webinar. Take care, stay safe, and we'll catch you at the next session. Thank you so much, David. Have a good night.
You too, and good trading, everyone. All the best.